Hello and welcome to the download. I'm your host, Dave Richardson, and it is time to catch up with Canada's hardest working economist, Eric Lascelles, who is, and Eric, we've got so many new listeners to the podcast. I've been getting actually one of the new listeners, Richard George. He and his colleagues have been saying, hey, you introduce Eric as the hardest working economist in Canada, which is nice. But what does he actually do for a living? Which is he is the chief economist at RBC Global Asset Management. And why we refer to him as Canada's hardest working economist is because I've never seen anyone produce so much content. Eric, your macro memo is it available to the general public?
It is, yes. It ends up getting posted on rbcgam.com. There's an insights tab. There's actually all sorts of great research, not just by me, but by various members of the investment team and of my team. But yes, it's right there, and so that's available to everybody.
I gotta say, if you have not read some of Eric's content, we have him on here every couple of weeks, so that's great, and we catch up in a quick 15-20 minute audio session. But the content that he produces, the macro memo last week, if you're concerned about tariffs, if you're wondering how tariffs really impact the broader economy, I thought his macro memo last week, I think it was released on April 7th, is just, I think it's stop number one if you want to try and understand this. It was just phenomenally written. And again, one of the other things, if you're a new listener, you'll find out is that I'm very fond of Eric, so I'm always praising him, probably overpraising him, but he's so modest you can do that with him. So Eric, thanks for joining us with all that preamble.
Gee, sure. I mean, if you like reading 7,000 words of something, it is definitely your report. I should say there is a table of contents. Pick and choose. These
Okay.
macro memos cover a lot, and so that may not be for everybody. But gosh, thanks for those kind words. And we never mention you, but you're an awfully hardworking guy yourself, and constantly traveling, and more than that.
There we go. So now that we finished the love fest, how much are you loving the economy right now? What we've had. So let's just go. Since the last time you were on, we've had the jobs reports out of the U.S. and Canada. We've
Mhm.
had some inflation reports out of the U.S., Canada, other parts of the world. We've obviously had all kinds of movement around the tariffs. So I don't know where you want to start in terms of how all of this leads to your thoughts on what the rest of the year looks like from a growth perspective.
Well, gosh, maybe to summarize in a nutshell, and maybe of more resonance to the Canadian viewers and listeners, but Bank of Canada just came out with a decision. That's not the purpose of what I'm about to say. They are very focused on scenario analysis right now, and so normally central banks have a forecast, and that's that. And this time they basically said, well, that's silly. There are so many ways this could go, and it's based on political decision making, which is very hard to predict in some cases. And so they are stepping back from that, and I think it's not unreasonable to think that speaks to the still quite high levels of uncertainty that exist and so on. And so, as you say, there's a couple of angles to go at here. Maybe just to start with on the tariff side. And so I think everybody knows, but since we last talked, of course, the big reciprocal tariffs did get partially unwound. And I think it's important to emphasize the partial part because there are still 10% tariffs on more than 100 countries. And of course, the tariffs on China actually went up, and there are still sector level tariffs, and there seem to be some pretty imminent threats of chip and pharmaceutical and perhaps forestry sector level tariffs to add on to the steel, aluminum, and auto tariffs. So I mean, it's still a tariff world, if a bit better than it was before. In terms of things we've learned, I think we have learned that, yes, the White House does have a limit to its indulgence for economic weakness and market weakness. So there was a moment of concern there that it was just going to go completely off the rails, and there was no accord being given to how the economy was absorbing these blows. And so it looks like there is some sympathy to that, and there is some limit to the extent to which these come on. I would say on a number of occasions now, and we hear rumors of auto tariffs being maybe lightened a little bit, and of course China had some exemptions applied for electronic products of various descriptions, and so we are kind of seeing full bore maximalist tariff applied, and then reality sets in, and we're seeing some pullback, and we're seeing some tweaks to make sure. And usually it's the reverse sequence. Usually you kind of proceed more slowly, and you put the well conceived of tariff that doesn't hurt parts of the economy you don't want to hurt all at once. But they do seem to be sort of getting toward a place that is still I would say, economically problematic and does speak to economic weakness and so on, but somewhat less so, I think, than maybe the fears that peaked a couple of weeks ago. And so, still looking for pretty modest economic growth this year if we're talking the U.S. and Canada and a number of markets for that matter. Not obvious, though, the way things are going, that it has to be a recessionary type outcome. So maybe that's the tariff preamble. Happy to elaborate, but that might be the starting point. Then the economic data, of course, here we are in a world in which we're still mostly dealing with data that predates, the significant application
Yeah.
of tariffs, I guess you could say, that came in a large way in early April. Though it should be said, of course, we did get some of those sector level tariffs in March, so some of the March data we're getting isn't completely irrelevant, but still. And so from a U.S. standpoint, I mean, the activity data is, I would say, mostly holding up. So what's happening in the U.S. is that you see the survey data and the sentiment data and confidence and sort of expectations data is quite cautious, and so there is some real movement there. The question is the extent to which it maps onto the actual decision making that happens, and I would say so far not that much. And so we had a payrolls number for March, and it was up a nice above consensus
Yep.
228,000 jobs, and you could nitpick it a bit, and there were some revisions to prior months and
Yep.
things, but job creation held up, and we can see the weekly jobless claims numbers are still holding pretty steady. So it doesn't look like there's been a sea change in how businesses are behaving, even given some Doge government cuts. And so it's actually
Yep.
holding together okay. We actually just got retail sales for the U.S. for March, and it
Yes.
was up quite strong. In fact, it was the biggest month in 2 years, I think. And so a lot of strength there. Let's be aware that there's probably a fair amount of front loading that's happening
Front
here. And
loading.
so
Yeah.
I don't think that's necessarily going to be sustained. People are trying to, or at least were trying to get that iPhone before the big, 145% tariff went on. Looks like those iPhones won't be subjected to those in the near term right now. But nevertheless, so, the data's been holding up, but with the caveat that, gee, some of these trade numbers look amazing because everybody is front loading. Some of the consumption numbers in the U.S. look quite good for that reason. We're going to learn a lot more shortly. One of the things we've been trying to do is to revive some of the real-time data we used to look at really closely in a pandemic context. And so, that
Ah.
the data's choppy. It really doesn't tell you much if the economy is just swimming forward at a normal rate. In fact, it probably lies more than it tells the truth because it does tend to be choppy. But when you have these open questions of just potentially quite substantial shifts in economic momentum, they can potentially tell us something. And so we've again revived those, and you can definitely see real weakness in the U.S. in travel, in airfares and airline travel and so on. And so that would presumably reflect the rest of the world boycotting to some extent the U.S. and I think some domestic caution as well within the U.S. So
Yeah.
that's a
Yeah.
source of real weakness. When we look elsewhere, though, and we look at sort of weekly economic indices, the Dallas Fed has one, and some others, mostly holding up for now. And so we still
Yeah.
expect some weakness later, but I wouldn't say it's been a stepping off a cliff moment by any means in the last couple of weeks.
And so you have all that background, and that's the hard data. Soft data, though, as you talk about that kind of tells a different story, and I'm just
Mm-hmm.
wondering your perspective on how worrisome that is. So if you look at business uncertainty, you talk to business leaders and you look at a chart of their uncertainty, it's never been at this level. I mean, we go back to stock market crash of 87, global financial crisis, the uncertainty level amongst business leaders is just off the charts. Consumer confidence dropping to, I think it's a 42-year low. Which takes you into some pretty rough times with regards to inflation. Inflation expectations spiking up, and
Mm-hmm.
that, as we know, and we've talked about a lot over the last few years, when inflation was the what we talked about most instead of tariffs. We talked about in inflation expectations being sort of that leading indicator of the direction that inflation's going. So for that to have come down and now kind of bouncing back up, that's an issue. And then I've been as I mentioned, I've been out with realtors lately, and they're saying that their business just kind of dried up
Yeah.
as you're coming into in Canada, which is of course your spring market. And
Mm-hmm.
so those are just things that start to make you go, wow, if we don't get some closure around this tariff thing, we may be heading to a tough spot.
Yeah, so it's a good point, and so I'd stand by everything I said. But as you say, here we are now looking into the future, certainly expecting some measure of economic damage. I'm not convinced it'll be quite as abysmal as some of those confidence and sentiment numbers suggest. Keep in mind, a fair amount is policy uncertainty, and I'd like to think at some point we will have some measure of policy clarity, even if it's not great clarity. And so that's part of the story. Keep in mind, of course, from an American standpoint, they have policy uncertainty on so many fronts. And so, will they get tax cuts? Won't they get tax cuts? To what extent will the government be cut? Will entitlements be sustained or not? What is happening at the border? The list goes on. There's a lot of policy chaos right now, and so I suppose, regardless of the source, that does induce caution. People are certainly less inclined, you would think, to spend and take risks and make big decisions. And really, this isn't a time for any big business around the world to make a big decision, you would think, to the extent that they need clarity on where that next factory needs to be, or what constitutes a viable market, or just what the cost of their goods, their inputs will be, or what the price of their outputs will be. So I fully expect a deceleration in activity, and yes, you'd expect consumer spending to be a whole lot more cautious, and capex and indeed hiring likely to be somewhat slower as well. And of course, if I'm doing the classic for the economists out there, the C plus I plus G minus plus X minus M, which is just kind of the way you add up GDP and look at some of the things we've just talked about: consumption, investment, government spending, exports and imports. Obviously, no one's expecting particular fireworks out of the export sector going forward as well. So it does add up to a significantly diminished rate of growth. If I didn't have models in front of me, I'd be really scared. But I do have models that do try at least to inform what the economic damage likely should be. And so for a long time, you may recall, we had 5 different scenarios, and they were
Yes.
kind of informed by what Trump had talked about on the campaign trail, which was which was that one? That was the 60% tariff on China, 10% on the world. Then, post-election, it was the 25% on Canada, Mexico, and I think it was 10% somehow then on China. And so there have been a lot of permutations, and we were trying to kind of maintain and juggle these different scenarios, and we've had to leap from one to the next. But to be honest, none has fully kind of precisely reflected what's going on out there. And so finally, we've broken down and said, okay, let's not pretend we can limit the range of possibilities to just a few different outcomes and get that exactly right. And so this is a bit of a scoop, Dave, for you maybe, but we have a table now that we're just about to unveil in presentations and papers. And so it really just says, listen, let's look at the major 6 or 7 countries. Let's just estimate the economic damage and the inflation effect and the unemployment effect. If tariffs are 0, if they're 5%, 10%, 15, 20, 25, all the way up to 100%, and just, pick your poison, and it just lets us pivot a bit more easily as things change. And so, we certainly have views in terms of where tariffs are likely to land. And I would say for the US, I would figure, without much precision or confidence, but I would figure maybe the effective tariff that they average and end up with at the end of this adventure is maybe in the realm of about a 15% average, as an example. And so you sort of plug that in. And for Canada, Mexico, it's a bit of a harder judge, because of course they seem to be enemies number 1 and 2, and now they're somehow friends number 1 and 2 and exempted from reciprocal tariffs, and it's a bit hard to square all of that. And so this could yet change, particularly as USMCA negotiations begin. But you would say that maybe in Canada the effective tariff vis-a-vis the US is maybe 5 to 10% right now, and maybe it ultimately settles at an average rate that's more like 10%. And so, to be clear, that would be a lot of things having no tariff. But then steel and aluminum having 25, and some fraction of autos having 25, and perhaps some other things that come along as well. And so as we run through those numbers, again, there's real economic damage. As it happens, just coincidentally, both in the US and Canadian context, you find yourself subtracting probably a little bit less than 2% from economic growth over the next couple of years. And so it's a real hit, hopefully just shy of a recession. If you'd asked me for Canada a couple of weeks ago, when it looked like Canada would also be hammered by reciprocal tariffs, we were fully expecting a recession, and a pretty deep one. And so we're in the weird business of potentially upgrading our forecast thinking for Canada if that worst case scenario is avoided. But it is still significant damage. You would expect unemployment rates that are a good percentage point higher than they would otherwise be, which is material for sure. You expect price levels that are maybe percentage point and a half higher or something like that, which is again entirely undesirable and has set inflation expectations loose and has created some maybe uncharacteristic behavior in the bond market, though I think there are some other things going on there as well. So not welcoming that at all, and it is greatly diminished. And of course, the stock market has discounted quite a lot of that already, I would argue.
Yeah. So again, you're like you said, the Bank of Canada scenario analysis, and which is what you typically do. You're just spreading your normally you have a smaller range of different number of scenarios, and now you're just kind of broadening out because there's so much uncertainty, and again just reflective of the environment that we're in, which is Again, tough on everybody. But I go back to the first podcast that we did a couple of months ago around tariffs, and even as we move forward and we go through the gyrations and the back and forth, that initial view still to me seems to be a likely where we end up. And is there any? Do you have any change in terms of your view in terms of whether this is almost purely a negotiating ploy, or is it really a policy that this administration wants to wants to implement? Because I imagine, like at your house on the weekends when you have, nine of your close economist friends over, that which it sounds like a blast around the fire pit. I'm going to guess that 0 out of your 10 economist friends like tariffs and think they're good from economic policy. So, where do you sit in terms of this? This is firm policy versus this is really a negotiation, and then to what end?
Yeah, I land somewhat inconveniently right in the middle in the sense that certainly some part of this is negotiations, and the U.S. has a big long list of grievances it has with other countries and concessions it would like to see made, and I think definitionally it will have to pull down some of these tariffs over time to see them achieved, and it's maybe a bit of a reversal recently in the sense that the tariffs were pulled down for 90 days on a lot of countries, in the hope of achieving those negotiations before those resume. So I don't expect the maximalist tariffs to persist indefinitely. I think just the economic tolerance and tolerance for market pain probably isn't quite there either, though it's proven greater than we first imagined. That's for sure. Conversely, I don't think it's all bluster because Trump is very keen on tariff revenue to help fund tax cuts, and he does genuinely believe in American businesses first and protecting American businesses and cultivating certain sectors and being less reliant on the rest of the world. And I and my other, I forget how many, 9 economist friends can argue till we're blue in the face that there will be net economic damage from that effort, and even if you manage, I think they will manage to pull some manufacturing jobs and other types of jobs onto the U.S. Unemployment rate's already low there. They're going to have to shed some other jobs. I mean, there isn't a magical way just to make the unemployment rate several percentage points lower without overheating and creating other problems later. So I'm not sure they end up too far ahead, but maybe that's not the point, which is, if the U.S. and if the White House is just willing to say, listen, this is a priority for us, and it's maybe not exclusively about GDP maximization and it's about achieving a particular sector mix, then that may be a pain they're worth a price they're willing to pay. And so I guess on that front, I would assume that we go from kind of high tariffs to moderate tariffs. And I guess as I indirectly, obliquely referred to earlier, I would think that maybe the average effective U.S. tariff ends up in the 15% range, whereas right now you could argue it's hard to say whether you count the reciprocal ones being on or off, but nevertheless it was considerably higher for a moment. It's maybe in that range right now, but we have some sector level tariffs coming and so on. So in the end, a consequential level of tariffs, but neither the maximum nor the minimum.
Yeah, as an old Seinfeld fan, it makes me think of we're about to go. We've got 1,371 days of permanent Festivus coming. The airing of grievances continues, but the when you look at again as we talked about your economist friends and the impact of the negative impact of tariffs in any way whatsoever, except that I guess it's being viewed as a way, as you say, of generating additional revenue, maybe offset some tax cuts, and that's part of the policy regime, or bringing back manufacturing jobs to the U.S.
Mm-hmm.
Economic. When you would look at that with your background, is that even a reasonable? Like, can you play out with through economic theory a way that this would actually work, and how many of those 9 friends around the fireplace with you would think that this is a way that you can actually get there?
It's tough to say. I mean, so again, clearly there's a degree of skepticism. The conventional wisdom, and I think ultimately the right interpretation is if the U.S. sticks with this plan, it will be a somewhat diminished economy, maybe with a slightly larger manufacturing sector, but on the net somewhat diminished with real incomes that are lower because prices will be higher and so on. So I would maybe that's the conclusion laid out first. Do know when we look into what happened to all those manufacturing jobs in the U.S. and in Canada and in other developed countries. Of course, some of those jobs did go to China and to other markets, and so perhaps there's some scope to reclaiming some of that. But the biggest source is automation. It's just
Yeah.
the number of workers you need per widget produced is far lower than it was, and I think that genie is out of the bottle and not going back, and so we shouldn't expect that to return. I would very much acknowledge that the manufacturing sector does play a special role within economies and
Sure.
probably does deserve additional regard and
Yeah.
beyond what its fairly small share of GDP would suggest. And even as an economist, boy, that ISM manufacturing index, which only reflects maybe 10% of what's happening in the U.S. economy, is one of the better economic bellwethers out there. So I do think it's close to the beating heart of the U.S. economy. But equally, even if you bring those jobs back or bring those industries back, you're not bringing that many jobs back. And indeed, to make the math work, if you are bringing industries back, and we're seeing some, I mean, I do expect that some onshoring will happen, and we're seeing commitments by big companies to do that. The impetus will be to automate even more and to make those factories even more productive, to render them viable, which means that you're not going to end up with that many, unfortunately, additional jobs coming from it. And then the other angle is, of course, the cost of some of these goods will be non-viable, and so of course people have tried to mock out the cost of an iPhone if it was produced domestically, and of course they've done it if subjected to tariffs, and it's
Yeah.
it's thousands of dollars more potentially, and so probably not entirely viable. And the wage differential is pretty jaw-dropping between even a minimum wage in the U.S. and the kind of wages that are paid in these other markets. And if society decides that it's worth paying those wages for
Yeah.
those products, then that's fine, and that's just a decision that gets made. But it will very much change the accessibility of products that are considered essentials right now and that are central to everybody's daily life.
Yeah. My kind of summary of everything you said is it's really hard to grow bananas in Edmonton. So
Right.
or expensive. But ultimately the objective of all of this, if I go back to the campaign, is that you're going to have this amazing period of economic growth. So once you go through this restructuring, does it actually get that? What are the mechanics that would get you to a period of much higher economic growth in the US? After the tariffs have had their effect, you've sort of restructured the economy. You've played around with debt and taxation, and is can you, as I like to say, can you square the circle on getting to a period after all of this where the U.S. economy starts to grow at a 3 to 4% trajectory versus where it's been over the last 20 years?
Yeah, I'm not sure that I can. I'm not sure we're there. I
Yeah.
mean, I guess I fall back on first economic principles, which is economic growth fundamentally comes from more workers and it comes from more productivity. And so the more worker side, of course, isn't particularly part of this policy mix. If anything, it's less. And we have yet to see maybe the full impact of a sharp decline in some of the less skilled workers from the U.S. economy. And so we'll see how that plays out, but certainly not a source for accelerating growth. And then you have the productivity side, and again, it's always complicated. I'm sure I've missed a few things here, but in general, you want to grow the industries that are productive and that you have a competitive advantage in. And of course, tariffs start to distort that and start to gum that up and basically say, hey, let's do things that we are definitionally less productive at because we're not even productive enough to have an industry of that type here. And if that's where the focus is, then the risk is that productivity grows less quickly as opposed to more quickly. So that would be, I guess, my central concern. And so if anything, you would think that not just in the short run, but maybe over the long run, if that pivot did occur, that you would actually have somewhat slower productivity growth. And, the beauty of trade is that in theory, all parties benefit and everyone ends up enjoying higher productivity because everyone specializes in the things that they're better at. And you just go get that cheap product that you're not as good at from somewhere else. And it's easy to think, oh well, it's just about prices, but just keep in mind, I mean, prices are ultimately a driver of what our real incomes is. You're in my salary. If the price goes up, has just gone down in inflation adjusted terms, and so real incomes go down when prices go up, and of course that compromises purchasing power and things. So I don't see an easy path there. I will say, I mean, let's recognize it is a messy world, and so you can imagine that if if for instance there was an entire industry in China and it was entirely there because everything, the whole whack of things they made was $1 cheaper, and so that justified everything being there. Well, probably does make sense to subsidize in the U.S. by $1.50, and you get 100,000 jobs and all this production. I mean, there are certainly scenarios in which there's a tipping point and you can pull something back. It doesn't feel like a lot of these industries are just at the cusp of that tipping point. It feels like there's a pretty fundamental difference there, and so it would require pretty enormous tariffs to justify. And as we're seeing, of course, with tariffs, then the other country reciprocates, and suddenly U.S. farmers aren't looking so good because they can't sell to that big Chinese market, and it gets complicated. There are knock-on effects. I've had conversations with Canadian companies who are feeling pretty keen on this, and they've got a real opportunity to sell something to China when they were previously not the low-cost, say, agricultural type competitor. And so all sorts of cascading consequences, but I think more losses than wins on the net.
Yeah. So many unintended consequences, and ultimately the execution of this is really challenging. As with anything, any strategy you embark on, it's a 10% strategy, 90% execution, and so far, at the very least, the execution's been clumsy, caused this disruption in markets, and we can only hope that we get some more clarity, and we continue at least on a positive path instead of a negative path in terms of growth, and not having a recession. But Eric, again, I do want to point out, if you like listening to Eric, we have him on every couple of weeks on the podcast. Please like and subscribe anywhere you get your podcasts. As well, we're on YouTube, as you can see. As I always say, people prefer to listen to us than watch us, but you can watch us if you want. And that if you like and subscribe now on YouTube, love to hear your comments and your reviews. And we'll have Eric on again in a couple of weeks to catch up on what's happening in the global economy. Eric, thank you so much for your time. I know how busy you are.
My absolute pleasure. Bye, everybody.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.
Like and subscribe.